Hello, everyone, and welcome to the Integrity as Our Compass podcast. I'm your host, Farah.
And I'm Nadia.
Today, we are diving into a very hot topic in accounting world, the dilemma at NTK Corporation.
So before we start, let me introduce our guests for podcast today. From my left, we have Miss Najwa, Miss Afika, and Miss Aina from NTK Corporation team. The last one, we have Miss Farihin as an accounting analysis. Miss Najwa, can you briefly explain what went wrong in this case?
Sure. The main issue is that the director prioritized loan compliance and making the financial position look better instead of following proper accounting standards. For example, they recognized full revenue even though there was a buyback arrangement which violates MFRS 15.
May I know why is that considered unethical?
This is considered unethical because revenue should only be recognized when the control is actually transferred to the customer. But in this case, it was not. So this action misleads users of the financial statements and does not reflect the true financial performance of the company.
I see. Are there any other issue as well?
Yes, the director also changed the useful life of assets without proper justification. This was done to manipulate depreciation and increase profit. On top of that, they hit Alphatech's bankruptcy, which violates the full disclosure principle.
That totally violates the standard. Revision to estimate must be based on objective evidence, not just artificial inflate the company profit. The issue combine both MFRS 108 and 116. For MFRS 106 allow changes in estimate to be applied prospectively. It strictly prohibited change made without a solid basis. Revision to estimate are only permitted if they are based on new information. In MFRS 116, the useful life of an asset must be reviewed at least at each financial year end. Depreciation must reflect the period over which the entity expects to use the asset.
Other than that, in our current practice, NTK initially omitted the bankruptcy of the major client because it happened just after the reporting year ended.
But that's an adjusting event because the condition existed at the end of the year. We must reflect the loss and reduce the trade receivable to ensure true financial reporting that reflect the MFRS 110 even after the reporting period.
Let's look at the EPS. What is the issue? How do you disclose it?
Based on the correct MFRS, which is MFRS 123 that explains how to treat the converted debts and EPS, we are required to disclose both basic and dilute EPS with equal prominence. Leaving out dilute EPS hide potential future dilution from investor and Zenith Bank.
That sounds serious. How does this relate to professional ethics?
Based on my recent reading, NTK breaches the IFSC Code of Ethics, especially integrity, objectivity, and professional behavior. It is a form of earnings management and could even be considered fraudulent financial reporting.
What about from an Islamic perspective?
I think from an adult perspective, these actions goes against values such as amanah, seed, and ad. The director is being dishonest and unfair to the stakeholders, which is not acceptable in Islam.
Now, let's talk about the accountant. What kind of dilemma are they facing?
The accountant is under pressure from the director, which creates an intimidation threat. As a probationary employee, they might be afraid of losing their job if they don't follow instructions.
So, what should the accountant do?
Ideally, they should maintain professional skepticism, refuse to participate in unethical practices, and report the issue to higher authorities like senior management or the audit committee.
That's not easy, especially for someone new.
True, but both professional standards and Islamic values emphasize honesty and accountability even under pressure.
Finally, how do these actions affect financial statements?
The financial statement become misleading and do not present a true and fair view. Key figures like profit, EPS, and ratio will be inaccurate. It also reduces reliability and comparability.
And what the consequences?
If discovered, it could lead to loan breaches, loss of investor trust, regulatory action, and serious damage to the company's reputation.
Oh, that's a big impact. Thank you for explaining this so clearly.
Okay, so we move to the next question. What exactly are the ethical problems with the director's action and how should they be handled from a decision making perspective?
Well, from a general perspective, the director action must really comply with financial reporting standard like MFRS. Beyond just the number, they have to uphold core ethical value such as amanah, sidq, and adil. In terms of decision making, the director should only recognize revenue when it is properly realized and ensure any changes like asset useful life are fully justified. They need to strengthen corporate governance and provide full transparency, especially for material events like customer bankruptcy. Continuous ethical training is also essential to prevent this issue.
That makes sense. But what about the staff involved? How should we view the accountant's dilemma when they are faced with unethical pressure?
Generally, an accountant is expected to maintain integrity, honesty, and accountability in all financial reporting, even under extreme pressure. When it's come to making a choice, the accountant should refuse unethical instruction and escalate the issue to higher authorities, such as the audit committee. It's crucial to document all action and seek professional guidance. If the situation doesn't improve, they must be prepared to step away from the role entirely to protect their ethical integrity.
Yes, I agree. But I think we also need to look at financial statement impact. Financial statements should always prevent a true and fair value not just in line with accounting standard but also guided by ethical values like justice. To achieve this, company need to correct any material misstatement and strengthen their internal control. Auditors should apply professional skepticism and ensure greater transparency with stakeholders. With continuous monitoring, this help maintain not only accuracy but also ethical integrity of the organization.
Alright, to conclude our discussion on NTK Corporation, this case highlight the conflict between achieving financial targets and maintaining ethical accounting practices. Due to pressure from loan covenants, NTK engaged in questionable actions like improper revenue recognition, unjustified changes in asset useful life, and omission of material information. This action clearly violates key ethical principles such as integrity, transparency, and accountability, as well as adab values like amanah and ad. So, the most important thing is the companies must not comply with standards like MFRS, but also uphold strong ethical values and governance to ensure reliable and trustworthy financial reporting. Thank you to our expected guests and thank you for listening. I am Farah.
And I'm Naja.
See you in our next podcast.
Bye.